The year is 421 BCE. A merchant named Nicomedes stands in the Athenian agora, clutching a small clay tablet. Etched into its surface are symbols that will change the world forever. A shipping contract, transferable to any bearer, backed by the promise of silver from the mines of Laurion. He doesn't know it yet, but he's holding the future in his hands. The first tradable security. The birth of the stock market. What he also doesn't know is that this innovation will destroy Athens within a generation. This is another video where money, power, and history collide. And nothing is ever as simple as it looks. The story we tell ourselves about financial markets is clean and simple. Ancient Greeks invented democracy, philosophy, and theatre. They gave us rational thought and civic virtue. Modern stock exchanges evolved much later, during the Dutch Golden Age, or perhaps in the coffee houses of 18th century London. The Greeks were too pure for such mercenary concerns. They valued honor over profit, wisdom over wealth. This story is a lie. By the 5th century BCE, Athens had created something far more sophisticated than most people realize. The Athenian maritime lending system wasn't just about financing ships. It was the world's first functioning capital market, complete with transferable securities, risk assessment, and speculative trading. The Piraeus harbour buzzed with financial innovation that wouldn't look out of place on Wall Street. The mechanism worked like this. Athenian merchants needed capital to fund trading expeditions across the Mediterranean. A voyage to Egypt or the Black Sea required months of investment before any return. Shipowners needed money for cargo, supplies, and crew wages. Traditional moneylenders charged ruinous rates. The solution came from an unexpected source, the legal system itself. Athenian law allowed for bottomry contracts, loans secured against a ship's hull and cargo. But here's where it gets interesting. These contracts were transferable. A lender could sell his claim to another investor before the ship returned. The original borrower never knew his debt had changed hands. Suddenly, you had a secondary market in maritime debt. Traders gathered in specific areas of the agora, buying and selling voyage contracts like modern derivatives. Risk was pooled, diversified, and traded. The silver mines of Laurion provided the liquidity. Athens controlled the ancient world's most productive silver deposits, generating enormous wealth that needed investment opportunities. Maritime lending offered returns of 20–30% on successful voyages. But the real innovation was the development of joint stock ventures. Multiple investors would pool resources to fund entire fleets. Profits and losses were shared proportionally. These partnerships, called koinonia, operated exactly like modern corporations. Wealthy Athenians like Passion and Phormion ran what we would recognize today as investment banks. They took deposits, made loans, and underwrote trading expeditions. Their operations spanned the entire Mediterranean, with correspondent relationships in every major port. The system created unprecedented prosperity. Athens in the 5th century BCE was the richest city in human history up to that point. The Parthenon wasn't built with tax revenue, it was financed by capital market profits. Aristophanes captured the mood in his comedies. Characters obsessed with interest rates and investment returns. Ordinary citizens discussing portfolio diversification. The language of finance had entered everyday Greek life. But prosperity bred complexity. And complexity bred corruption. The Athenian system had a fatal flaw. It was built on slavery and imperial exploitation. The silver mines that provided liquidity were worked by tens of thousands of slaves. The trading networks that generated profits depended on Athenian naval supremacy and tribute from subject cities. The capital markets weren't separate from Athenian imperialism, they were its engine. Wealthy investors used their financial networks to influence foreign policy. Wars were started to protect trade routes. Diplomatic agreements favored cities that offered better commercial terms. The Athenian assembly, supposedly the voice of democratic will, increasingly served the interests of maritime capital. The crisis came during the Peloponnesian War. Massive military expenditures strained public finances. The solution was to issue debt backed by future tribute payments from the empire. Athenian citizens could buy bonds secured by the promise of victory. The more territory Athens conquered, the higher the returns. War had become a financial product. This created a vicious cycle. Military campaigns were planned not for strategic value, but for their impact on bond prices. Generals were chosen based on their ability to generate investor confidence rather than tactical skill. The Sicilian Expedition of 415 BCE was the ultimate expression of this logic. A massive investment in conquest, marketed to citizens as the deal of a lifetime. Victory would double their money. Defeat was unthinkable. The expedition was a catastrophe. Athens lost its entire fleet and most of its army. The bonds became worthless overnight. Thousands of citizens who had invested their life savings faced ruin. The financial collapse triggered political chaos. The democracy that had created the markets now turned against them. Demagogues blamed the disaster on wealthy speculators and foreign traders. Mobs attacked the Piraeus banking district. In 411 BCE, an oligarchic coup briefly overthrew the democracy. The new regime promised to restore traditional values and eliminate financial speculation. They lasted 8 months before popular uprising restored democratic rule. But the damage was done. The capital markets never fully recovered. Silver production declined as slave rebellions disrupted the mines. Trading networks collapsed as Athens lost control of the sea lanes. By 404 BCE, when Sparta finally defeated Athens, the city's financial system was a shadow of its former self. The world's first capital market had destroyed the civilization that created it. The parallels to modern finance are unsettling. Complex financial instruments that seem to eliminate risk. Debt secured by imperial power and resource extraction. Democratic institutions captured by financial interests. The belief that markets could solve political problems through private profit. We see the same patterns in the Dutch tulip mania, the South Sea bubble, and the 2008 financial crisis. Innovation creates wealth, wealth concentrates power, power corrupts the system, and the system eventually collapses under its own contradictions. The names have changed. The behavior hasn't. Modern stock exchanges trace their ancestry directly back to those clay tablets in the Athenian agora. The fundamental logic remains identical. Transform future uncertainty into present tradable value. But we've forgotten the lesson Athens learned too late. Financial markets aren't neutral tools for allocating capital. They're political institutions that shape the societies that create them. The Greeks didn't just invent the stock market. They invented the illusion that money and power could be separated. That markets could exist apart from politics. That private profit and public good naturally aligned. History doesn't repeat. But it does reveal the same eternal truth. Every system built on the promise of endless growth eventually consumes the civilization that created it. The question isn't whether we can create better financial markets. The question is whether we can create them without losing our souls.